GCU has competitive life insurance, and it's time you've checked it out. My name is Ashley Guthridge, GCU Sales Coordinator, and today, let's talk life insurance. GCU has withstood many historic challenges throughout our 130 years. We are known for our strength, stability, and security. Our financial facts speak for themselves. Here's a closer look. As you can see, our solvency ratio is 109.5%, and our assets are over $2.3 billion. GCU is proud to be debt-free. Now for our main attraction, whole life insurance. You've already written your client into one of our annuities, so let's find out if they also need life insurance. Annuities have many great benefits, like they avoid probate and are great for tax deferral for their non-qualified money. But what if your client wants wealth transfer? Annuities are not the best wealth transfer vehicles because of the taxable buildup in non-qualified contracts and the zero cost basis of qualified contracts. Your clients can potentially leave a huge tax liability for their families to deal with after their passing. Non-qualified annuities do not receive a step up in basis, and depending on the beneficiary's income level, the IRS could take 30% or more of the annuity value. It might make sense for your client to turn some of their taxable money into tax-free dollars. If that is the case, you should approach life insurance as a solution. If you use a portion of the annuity, they can buy life insurance now and they'll be prepared when the taxable event happens. With the income tax-free treatment of the life insurance death benefits, beneficiaries receive a larger inheritance even after the tax bill has been paid. Let's look at Betty Barber. She's a 75-year-old female with $200,000 and a non-qualified annuity. Cost basis is $100,000 with an interest rate of 3%. Betty has her 3 children as her beneficiaries. If she kept all her money in the annuity, her kids would end up getting $56,666 each after Betty's passing. If Betty took the 3% interest every year to purchase life insurance, that $200,000 becomes $170,000 after she pays taxes. Add $115,300 of life insurance is $285,300. So her 3 children would end up with $95,100 each, which is a 68% increase. Now let's look at the same scenario for Betty, but using qualified money instead of non-qualified. If she kept all the money in the annuity, the 3 children would only end up with $46,666. If you use Betty's RMD to buy life insurance, take that $200,000 divided by 22.9 is $8,700. She would have $191,300 left, less taxes of $57,390, which leaves $133,910, plus the life insurance of $167,000. That would give you a 3-way split of $300,000, $910 total, and that is $100,303 per child after the taxes were paid. Here's the required minimum distributions calculator. This is showing Betty's RMD situation factoring in the 3% growth. Even though the RMD is greater than the annual growth, here's what age 86 looks like. You have the IRA, $146,173, less 30% taxes is $102,322, plus life insurance and PUAs of $179,816 is $282,138 after taxes. Let's split that 3 ways. $94,046 per child. At age 86, if she didn't buy the life insurance, each child would receive $34,107. Now, here's 2 questions to ask your client the next time you see them. If you didn't have to take your RMD, would you? which is a great question to ask your client because if they do not want or need to take it, you can utilize that money like putting it into a whole life policy. Live on or leave on. Is your client living on their RMDs or annuities? If not, they're probably interested in leaving a legacy for their kids or grandchildren. If you ask these two simple questions, you can learn a lot about your client. You can find all of our life insurance applications, guidebooks, and illustration software on our website, link attached here. Download our software and just see how competitive GCU Whole Life Insurance is compared to your other carriers. Hope you have a great day and happy selling.